There are so many questions these days about retirement planning and annuities. The internet is full of them. My team has chosen several questions from Reddit, and we're going to talk about them. Let's dive into question number one.
Our first question comes from Scott R. Francis. He says he's 57 years old, wants to work for another 10 years or so. He's been shopping for advisors, and he was interviewing an advisor recently, and he suggested adding a deferred annuity. He says, I'm somewhat allergic to annuities, but perhaps I'm being short-sighted. Any thoughts about this vehicle in general and when it would be advantageous or not?
Well, he's actually at 57, he's in what we call the financial red zone. And that's an ultimate time to be looking around to plan your retirement vehicles, your sources of income, the places that are going to be your engines for retirement, the ones that are going to produce that income so you and your family can do anything you want within reason all the way through retirement. So at 57, I think that's the ultimate age, 10 more years to retire. I mean, he's in a sweet spot right there to get the ultimate GPI plan, growth, protection, lifetime income that annuities supply if he gets the right annuity. He said a deferred annuity. There's so many different kind of annuities with a different first name. It's hard to say what deferred could mean. It could be a deferred variable annuity, which puts your money at risk. It could be deferred fixed annuity, which gives you a set amount of interest each year for a certain term, sort of like a CD at the bank. But the ultimate one for the retirement vehicle would be a deferred fixed indexed annuity, which with an income rider attached. Now, deferred fixed income means you get to share in the gain of some market index, and there's a lot of different ones out there depending on what annuity he picks. But you share in the gain of the index, but you never share in the loss of the index. So you can ratchet up your money, and then if you put an income rider on there, the income rider promises your money will grow by a certain percentage every single year for a lifetime income you can't outlive. Let's say it's a 6 or 7% income rider, or maybe even 8%. If you use the rule of 72, you take, let's say, a 7% interest, 7 goes into 72, 10. Every 10 years, your money doubles that way. So there's so many great choices for this individual right here, and he should not overlook the factor that lifetime income is the most important aspect of his whole retirement plan.
Coach, this one comes from Frolicking Banana. Says, I've been saving up for retirement, but trying to figure out how to balance it out. Now, I've seen some older folks with a ton of money in the bank and not living life. What's the point of doing that? I've also seen folks blow off their retirement way too early and regret it till their end. I'm trying to figure out how to tread the middle. Ideally, I'd like to spend the last penny I have on the last day I'm alive, but since we can't predict lifetimes or the market or the economy accurately, I'm super confused how to balance this out. Is anybody in retirement have wisdom on that? Meaning you, Coach?
Well, I've been planning for retirement for other folks for 32 years. I've been planning my same retirement, I've been planning my retirement at the same time too. This is always amazing to me sometimes, where if you go to see a car salesman, he's trying to sell you a Cadillac, let's say, but the car he drives is a Toyota. So, I mean, if you're dealing with a planner, the planner should believe in what they're trying to offer you. How much do they really believe in it? So if I recommend life insurance to somebody, I know I have that life insurance policy already. I've already tried it. Years ago, the Biography Channel did a special on me, and they called me the Mikey of the financial world, because I try things first before I ever tell my clients about them. And some you never hear about because they wouldn't work out. And I want to be the test rabbit, not my client. Very, very important, though, to make sure you understand everything that's available in the financial world, and you get a planner who takes that philosophy that they endorse what they offer. Because how do they endorse it? They endorse it by having one themselves.
So, Coach, every day, tens of thousands of people retire, and a lot of people that are retiring have also inherited annuity along the way. What's that look like? What do you do with it? What are your options?
Well, the number one thing you should do when something happens bad, I mean, if you're inheriting it, something bad happened. So don't make a snap decision. Sit down, take your time. Don't let anyone force you into doing anything quick, because that's what happens a lot of times. We're in a period of grief. Some things we shouldn't be doing. So analyze that annuity. Some annuities let you continue what's the annuity is. So if you already have a stream of income, maybe you can continue that stream of income. Or you can take the lump sum and you can move it other places. Keep in mind, there's some good places and bad places to put it. If you like the concept of an annuity, they're probably better annuities these days because they seem to get better every year. There's more options. There's something called a living benefit rider, which is really good. So it's all about looking at the choices you have before you make a decision. And I can't believe that's about $10,000 a year. That's a lot of moving money, we call it. And it's also a lot of times where sharks appear. So be very careful making that decision. Well, it depends on what kind of annuity it is. If it's a qualified annuity, that means it's an IRA. No one's paid tax on that yet. So guess who gets to pay tax on it? Well, you or they tax it before you get it. So if it's a non-qualified one, it has some special tax privileges where you don't have to pay tax on a lot of the stuff there. So it's all about, and again, I'm not a tax attorney. I'm not even an accountant. So we work with CPAs in our company to make sure that people don't, and also estate planning attorneys, to make sure people don't make snap decisions that end up coming back and slapping them.
Got it. So, Coach, when setting up an annuity, are there some things that we need to consider, like returns on our premiums or death benefits? Or...
Well, the cool thing about most annuities set up, they say automatically when you die, 100% of the value of the annuity goes on to a beneficiary you've already assigned. So that's really nice. And it bypasses probate, too, which doesn't get caught up in the court process. It would save you about 3% on that, by the way. Probate costs could be 3 to 5%. So if you bypass it with that money, they're not going to be able to take any of it. So as far as the death benefit, that's covered. And return of premium, I think you mentioned, really, you don't. That's the same thing as a death benefit. So unless you had taken some money out ahead of time, and there wasn't as much money in there, so it makes a lot of sense just to consider annuities. Make sure you have the right one, though.
So, Coach, I have always wondered how in the world insurance companies make money on a fixed indexed annuity. Can you tell me more about that?
Yeah. First of all, a fixed indexed annuity lets you share in the gain of the market without sharing in the downs of the market. So they have downside protection and upside potential. Makes a lot of sense. You don't get all the upside, obviously. The insurance company go out of business but so they make money there on the difference between what they promise you in the contract and what the total gain is. But the main way, people say, well, how can they afford to give you all that downside protection and only take a little bit of upside for themselves? They take whatever money people give them. They put it into their general funds. They get an interest on that, obviously. They buy options with the interest on the money they have. So the options are both up and down on the market. They straddle the market. So some of them expire worthless if the market's going wrong, but some make money. So they make money on that index. That's how they can afford to pay you a share of the gain on the market. See? So they have very fancy money managers at insurance companies, and they have billions of dollars we're talking about. So they get better rates than we do anyway. So they have a good profit margin without having to rip off their customers. If you follow the rules of annuity, they never take a penny from you. If you take it, put it in for 10 years, you don't take it out. Like, don't take all it out in 10 years. They don't have any surrender fees. It's all liquid for you. If you take out 10% a year, they don't have any fees either. The only fee they have is on what they call it a fee. It's when you're sharing in the gain. So you can't get all the gain, so they take a fee out to make sure they compensate themselves. But you get no loss, so that fee basically covers the downside.
So I frequently hear you refer to GPI, or grow, protect, and income.
Yeah.
Can you tell me a little bit more about that?
It's so vitally important as we get close to retirement. We want our money any time in our life, basically. But as we get close to retirement, one aspect comes more clear. You always want your money to grow. So if we could grow your money and protect our money. In other words, we want a growth, but we don't want to give the money back the next year. Growth, protection, and then sometime in the future, you'll want income. And as we get closer to retirement, we know income is more and more important. So grow your money, protect that growth. When everybody else is losing, you're protected up here. And then eventually you want lifetime income. Now, when we say income, we mean lifetime income for you and your spouse. Money you can never outlive, money that'll always be there. And this is a zinger. Even if your balance in that account goes to zero, the income continues to go when either one of you is still breathing, still here on this earth. That's why we love growth, protection, income accounts.
So, Coach, I know there's always a lot of discussion around bonds, but they aren't necessarily the best choice for everyone. What are your thoughts about that?
Yeah, bonds less and less of a part of anyone's plan these days because as interest rates go up, bond prices go down. So if you buy a bond now, let's say you bought a bond 3 years ago. At this price, interest rates went up, your bonds, you can't even sell your bond for what you got it for. So it depends on the term of the bond too. A lot of times 10-year, 20-year, 30-year. If you have a 10-year bond, if you wait 10 years, you can get your money back. It's a long time to wait. You get a lower rate though. So if you get a 20-year bond, you get a little higher rate. 30-year bond even higher, but you have to wait 30 years. So if we're in this kind of environment where your bond's not worth what you put in, you have to wait 30 years to get it back to even. If you're on a bond fund, you never can get your money back out. So be very careful on bond funds. We like annuities as an alternative to bonds because your money's protected. You can have lifetime income. You can even share in the gain of the stock market in some annuities. So you've got everything that everybody liked about a bond plus some now in an annuity. The only reason you'd buy a bond is if you were dealing with a stockbroker who had no other thing to offer you for a safe object, because bonds aren't as safe as they used to be, in my opinion. Bonds aren't completely safe anyway, but they're safer than stocks. So when the stock market offers you the safer alternative, it still has risk. So know that before you ever put money in bonds, but also know there's better alternatives, in my opinion, than bonds to begin with.
So I know, Coach, I, for one, am completely overwhelmed when it comes to discussing retirement planning. And I personally am in what you call the financial red zone. I'm 58. My husband's 8 years older than I am. And it's daunting to think about tackling this on our own. And talk to me about the importance of planning and the importance of finding a good coach to help you with planning.
Yeah, the coach also also acts as a referee sometimes. You've got two people here, we're getting ready to retire, and then maybe one person wants to do one thing and the other person wants to do something else. So the coach is a good person there to step in the middle, but also a coach that has experience. Experienced coach. 32 years I've been experienced in retirement coaching. So I've seen what works, I've seen what doesn't work, unfortunately. But the good thing about me seeing what hasn't worked for other people is that I can show you what not to do. Albert Einstein once said that smart people learn from their mistakes, but geniuses learn from other people's mistakes. So you don't have to make the mistakes to learn from them. And so we've seen about every mistake I could ever imagine in the 32 years that I've been and planning for retirement for other folks. So it's just important, though, to have somebody that you can trust, depend on, and won't overcharge you. I've seen people get killed in fees, and so what good is it to have a planner if the planner is the one causing financial evaporation? If the planner is, in fact, a financial termite eating away at your own money. So we always say, whose retirement are you planning for or succeeding with? You, or if your broker is the one succeeding on your money, then we're in the wrong place. If you both succeed, that's good, but you need to be the one winning all the time. So just make sure you get somebody you can trust, and it has to be one both spouses can trust too, and that's a little tougher too. But if you both can agree on somebody, then it makes a lot more sense. So everyone's going to approach this part. Don't feel overdaunted. We all feel that way. We all feel like we're the only one. Everyone's gone through that before. It can be done the right way, but just don't make impulsive decisions. So just make sure when you're building your plan if you have any NVIDIA, like I've got 50 shares, I'm not selling mine because I can afford to take that risk, but I'm already up 4 times. In theory, I should probably sell 10 shares and get all the money I invested in back, and now I'm just playing with what they call the house money. But I'm going to leave it in there, let it ride for a while. If it's $1,000 a share, I probably will sell 25 shares. Why not? $25,000. When you think about what I paid, $50 at $199, I paid $10,000 for that. So $10,000 to, what I say, $100,000 or $200, that's a lot, or a lot of money. And we'll see you later.